Thank you. I appreciate it. It's a great opportunity to be here, and I appreciate Mary for bringing me in. I first started working with the Small Business Office at JSU in 2012, and so I have a long relationship with them. I've used them for many different resources, sometimes just for a sounding board, talk over ideas and look for opportunities, things that could help my business. So I highly recommend working with Mary and Ken at the Small Business. They're very helpful to any small business. Refer them to the people you work with. They're a great resource for our area here in Alabama. I'm going to start with, I've got a PowerPoint called Insurance 101. It's about commercial insurance. And it starts out, it says, the large print giveth and the small print taketh away. And it's kind of a funny thing, but when you look at an insurance contract, when you get your policy or your deck page, there's large print, there's small print. And so it is just like what it says. The large print gives you the coverages, and the small print is usually the exclusions, the definitions, or the things that limit the contract. And so there are many parts to that. And we're just going to go through that today through our PowerPoint presentation. There we go. All right, so a good idea when you're working with anybody who's asking you about how they get insurance for their small business or what they need to be looking for, you really need a good agent. You need somebody that's knowledgeable who will consult with you and talk with you about the insurance product. If you're involved in the process is another good thing. We get clients that really all they want to know is how much to write the check for and where they sign, because they just want to get the thing out of the way and move on to their job. But it's better if you're involved in the process. If you focus on the cost of risk and not the cost of insurance, then you'll be okay. So what does that mean? Well, I mean, obviously the whole idea behind insurance is to share the risk with another. And so for a fee, for instance, if you put $30,000 in your car, for a fee, the insurance company says, you know, if something happens to your car, we'll replace it for you. So you're sharing that risk for a small fee. And often it's really a pretty good deal. I mean, if you think about it, for a $60,000 truck, if you in for $1,200 a year perhaps, you get your truck replaced if anything happens to it. And so it takes the risk out of owning and investing in that vehicle away from you. So it is with small business. A couple of different ways you can purchase insurance: through direct writers and through independents. A lot of people haven't really thought about this, but think about your State Farm guy and your Alpha guy. They basically are direct writers. They write basically for one company. And then I'm an independent, so that means I can write insurance for many different carriers. So where that comes into play in commercial insurance, often there's things that State Farm can't write, Allstate won't write, or Alpha won't write, but we can usually get coverage for anything. So I wrote an insurance policy for a zombie convoy, a literal zombie convoy, where they were going to shoot zombies with air guns from the back of a deuce-and-a-half truck. So if I can insure that, I can insure anything. So there's the application process. It's best if you meet with your agent one-on-one, discuss the what-if questions. You need to start 90 days out before you plan on starting your business, getting your insurance in order. It takes a while to get some of these things in place. If I'm writing an electrician, for instance, I can probably write that policy in 15 minutes and he can leave with insurance. But if it's some of the more limited class codes, something higher risk, then it may take several weeks to get the policy in place. So when you're working with people or trying to give advice to people, these are some of the things they need to think about, is getting all this in order ahead of time. We're going to discuss property insurance. Again, we talked about the transference of risk. That's what insurance is. You can see here on the screen all the disasters that can happen to the property you own. And as an insurance agent, I've seen everything on the screen for certain firsthand. There are several facets to property insurance: building and contents, and how are they defined? What are the perils? Which form do I buy? Improvements and betterments versus contents, and business income. We'll discuss all these things. On property insurance, the small print talks about the percentage of the deductible. What about stuff that's in your care? Sometimes you might have a business that has to work on people's stuff, whether it's their car or their furniture, or maybe you're going in the home to work on their stuff, and you could damage something. So the risk to you as a business owner is that you might damage somebody else's items, property damage that's caused by you. There's your things that are off premises or in transit. You know, what if you had $5,000 worth of T-shirts here at the chamber and they're in a van headed across town? Something could happen to the van and you could lose the T-shirts. So you can buy insurance coverage for all those things. Flood, equipment breakdown. Equipment breakdown is kind of a trending topic right now in homeowners insurance because it can pay for your HVAC system if something happens to it. So there are always some coverage for that depending upon the peril, but some of the equipment breakdown coverage will even cover wear and tear, which is unusual. That's kind of a new trend. Coinsurance Demystified. This is having to do with owning a building and insuring that building for a certain value. A building such as this is owned by someone, and perhaps the chamber's a tenant, maybe they own it, I'm not sure the ownership structure, but it's insured for a certain value. Usually a valuable building is insured for a complete replacement cost. So that means, you know, how much would it cost to build another building like this? And then they want to insure it for at least enough to build another one like it. So that is a replacement cost value. So we're going to talk about coinsurance. What happens when it's not insured for a complete replacement cost? There are policies that do this. The advantage to the owner of the building is it's a lower cost product, cost less, but they're taking more risk because they didn't insure it for enough money to build another one like it. So there could be a coinsurance clause in the contract, and that's what they're describing here. Often somebody will come to me wanting insurance on that building. They want enough to cover the loan. That's all they want, $240,000 in this example. The mortgage company is happy because they got enough money to repay the loan. That's all they really care about is their interest in it. But there's an 80% coinsurance clause in the contract. Notice how it says it's lurking. It's a small print item generally. And so the building is damaged in a fire, $150,000 worth of damage. How much do they get to repair that $150,000? Because it wasn't insured at 80% replacement cost, let's look at that. The adjuster determines replacement costs. In this scenario, he's saying the building's worth $600,000. Well, we know, I have made my screen different. I'm sorry. I got to not touch that. So anyway, in this example, the building's worth $600,000 as a replacement cost. He only insured it for $250,000. It was $150,000 worth of damage. So what happens? Because he didn't match the 80% replacement cost threshold, there's a penalty. And you can see at the bottom of the screen, it's 50% less in this scenario because it was insured for less than 50% of the replacement cost value. So he only gets $75,000. He experienced a penalty on this contract because it wasn't insured for replacement cost value. So he assumed more risk instead of transferring more risk. And this is just kind of the result of how that would probably work. So now we're going to talk about general liability. Every business needs a general liability policy, and this protects you from the risk of damaging somebody else's property or somebody's bodily injury that could result in something that you've done. I've owned several different businesses through the years, and I've had them all insured, of course. But I'll give you an example of this. Let's say a painter's at a house, and he breaks the windows out with his ladder. He knocks a big plate glass window out. So he's liable to have to pay for that because he broke it, he's got to fix it. The insurance policy could pay for that if he has a general liability policy. So it covers the personal properties of others, contractual liability, so he gets sued, somebody says you didn't fulfill your contract. Your insurance could cover that lawsuit. Subcontractors are working under this guy perhaps, and so their insurance is covered by this general liability policy. You can do that two different ways, but think of a general contractor who's a home builder, and he gets hired to go out and do a house, and he's going to put an addition on the house. And so his guys frame it up, build the foundation, build the floor, build the walls, but then he hires an electrician to wire it, and he hires a plumber to come plumb it. he hires an HVAC guy, he hires a roofer. All those are subcontractors to him. So will his insurance cover anything that happens with any of those guys? And the answer is, if he has properly insured general liability policy, it will. So the electrician maybe causes a fire and burns things or damages things, or the plumber takes a piece of equipment like a backhoe and hits the wall of the house and damages it severely. So the contractor can have his insurance cover that, but his insurance is going to go, hey, the plumber did this. We need to see his policy, because they want to be reimbursed by his insurance, because that just helps them on their bottom line. So what the general contractor does is he has a certificate of insurance on every sub he hires. So he knows who has their insurance, the policy's in force, and know that he's properly insured. And then he lists himself perhaps as an additional insured is another way that can be done. So that if there's any of those eventualities do happen, his insurance can go to the other insurance company for the money. Commercial auto, most of the claims are small, but you have the what ifs. I have a friend who was involved in an accident yesterday, and there were 6 cars piled up on the interstate. They were somewhere right in the middle of it, but they were on business. And so, their insurance come into play on how that's going to get settled, as they decide who's at fault. So sometimes it's a little fender bender, but sometimes it's a much more worse accident. There could be bodily injury involved, hospital bills, surgeries, time missed from work. You could be responsible for all those things. So it's best to have a commercial auto policy that has a large liability portion in it. The basics. Liability pays for bodily injury or property damage. I heard of a case where someone got injured on their way to work in the morning, and they missed 6 months of work. The gentleman who hit her car was at fault. He only had $100,000 on his liability. But now he's paying her surgeries, her medical bills, and 6 months worth of missed work. And $100,000 wasn't enough. There was a lawsuit then, and they attached it onto his house. He had to redo his mortgage, to pay for what he had damaged. The bodily injury portion was quite large. So it's best to do yourself a favor and have at least $1 million on your commercial auto. It's not as expensive as most people think, and if you have that worst case scenario happen, you want to have plenty of money right there. We were in a small accident in my family, and there was a lawsuit, and we were sued for $150,000. Sorry, I had $1 million on my mind. And they didn't win the $150,000. They did get $30,000 though. We're going to talk about that in a minute, how that worked. Uninsured motorist coverage. A lot of people think various things about uninsured motorists. What it pays is your bodily injury if their insurance is not there or not enough. It pays your bodily injury by your insurance company. So we've had an experience like that in my family as well. Collision pays for the things pays for your car if you collide with something. And comprehensive pays for everything else. We could break that down, but comprehensive pays for like fire, theft, vandalism, hail damage, wind damage, storm damage. If you hit a dog or hit a deer, even though you collided with it, it's covered under your comprehensive line. So that's why you have comp, and then you have collision for things you collide with. Now here's a couple of things that gets real important if you have employees, but non-owned auto, every business should have this. So let's say a realtor in town, he's got several realtors and some other people work in the office, and he's got a 1 mil, 2 mil general liability policy, and he includes the non-owned rider. It's not automatic, you have to select it on his policy. What does that do for him? Well, let's say one of the girls that works in his office is driving around and she's got $25.50 on her liability, which is the state minimum. And she's in an accident that's her fault, but she is, doing something for work. It's work related that she's traveling for across town to pick up things at the office store. So if he has non-owned, then this $1 million portion of his general liability policy would cover the liability in that accident, even though she's in her car and it's her fault. Because if he doesn't have that and her insurance has exceeded the $25,000 wasn't enough for the bodily injury, then it comes back to him and he may have to pay out of pocket because she's his employee and she's driving across town to pick up things at the office store. So it's best to have non-owned on your commercial general liability. Hired auto does the same thing for cars that are rented. You can add towing and renter, and it says size matters. It's talking about the size of the vehicle. It does make a play on how much you pay for insurance. MVRs are ran on the people who are driving the cars who work in the business. Workers' compensation will pay if your workers are injured. A lot of business owners don't realize the value of this because it protects them if their employee is injured. And so it's very necessary to have workers' comp. A lot of people skip it and they say, well, I'm small, I'm not required by the state. But it could be a quite expensive endeavor if you have to pay for somebody's injury who's working for you. There's a small print in the workers' compensation. Owners and officers can exclude themselves. It saves money on the premium, but they don't have any coverage. You can't exclude anybody who is on a W-2 or a 1099. They all have to be part of your workers' comp package. There is an audit process for these things to be sure you paid enough or didn't overpay. And then again, with the subs, sometimes you want to hold somebody else's certificate of insurance as an additional insured to be sure their workers' comp is in force. Professional liability, I think we all kind of understand this. Usually we think of it with doctors and dentists and things in their malpractice insurance. But there are many other types of professional liability. But if you're in a class code where you give advice to others, you probably need a professional liability policy. A couple of different kinds. Claims made in occurrence, we'll discuss that at further detail in just a second. Occurrence form. Most general liability policies are going to be occurrence form. So you might have an incident that happened in 2012, but the claim wasn't filed in 2013. Let's say you were a home builder and problems with the construction didn't show up for 2 or 3 years later. They would go back to your 2012 policy to file that claim. And it's good that you have it, but there's a policy period. In your cards, sometimes it's 6 months. Most of these policies are going to be 12-month policies, and they afford you coverage for this much money you pay them, from June to June, perhaps. So if there's a claim that happened while the policy was in force, you can go back to that policy and file it. Sometimes, this is not uncommon for something to have happened, but it really doesn't show up till later. But hailstorms are kind of like that on your roof. You may have changed. Maybe you were with Company A when the hailstorm hit, but you didn't know your roof was damaged. And now you're with Company B, but now the roofer says, hey, you've got all kind of hail damage up here. And he looks back and he says, there was that storm in 2012 in June, and he said, that's the storm that got you. It hit all these houses on that date. And so now you're back filing a claim against your old homeowner's policy. You can do that. A lot of people are surprised, but that's because it's an occurrence form policy. So in business, this gets pretty important. The opposite of that is a claims made policy. The claim has to be filed in a timely manner on a claims made policy. And you might ask, well, why would they do that since the other one sounds better? It's because it limits how much the insurance company is liable for. So they may sell you a claims made policy, and it's probably going to cost you less because they have less exposure. The claim has to be filed while the policy is active during that policy period. There's not that many of those out there. Professional liability. These are based on class codes. All insurance is based on class codes on commercial. Let's say you have a company and you've got 3 roofers that roof houses in your business, and you've got 1 clerical person that does all the bills. Well, you would put down a class code for the 3 who work in roofing. It costs a lot because their exposure is pretty severe. But the clerical person would get a really cheap rate because they're not exposed to the same exposure. So they all work for a roofing company, but they're not all under the same class code. Professional liability is that way and workers' comp's that way. And, well, the GL is too, except it would be a GL for a roofing company in my example. Cyber liability becomes a big deal these days, but the staffing company, for instance, you've got personal information of thousands and thousands of people. if somebody was to breach into your system and get all the Social Security numbers and date of birth and begin, wreaking havoc in their lives with that, they could come to you with a lawsuit. And how do you handle that risk? Is you have cyber liability, and I'm sure y'all's policy has a cyber liability component in it. And it should be based upon the number of people that you have information on, and it should be based in around, I think the last number I heard was $200 or $300 per person. So you could see where that could be quite a large number, and it's not an inexpensive coverage. It's kind of high, but it does protect you from that risk. There are several different things that can be added to these policies or a separate policy in conjunction with umbrella policy. I think a lot of everybody knows it's just an extra layer of liability on top of the liability you already have. You can have these for personal, you can have them for commercial. Pardon me. Commercial crime, you notice employee dishonesty is in there. If you have an employee that's stealing from the company, that can be covered on your insurance policy so you don't absorb the loss. Again, it's just another risk you can insure against. Employment practices liability. If your employee sues you, your employee practices liability coverage would cover that lawsuit for you. Employee benefits liability, the same thing. And then flood and excess flood are policies that one could have to cover their properties. You're always looking at the cost of the insurance and your budget, but you have to be sure you have the adequate coverages for all these risks we just discussed. And so it's a bit of a balancing act. You want to be sure you can afford the premium, but you got to be sure you have the risk covered too. So what you should expect, your agent should be involved with your risk assessment, should give you advice on what these coverages that you absolutely have to have are, help you wade through the auxiliary coverages that you may need. They should be responsive, look at your risk management, teach you about your risk management, give you guidance, and that would make somebody that's a trusted advisor, not a salesperson. He's trying to be sure you get your insurance the right way. But ultimately, the owner of the business is driving the bus. And I think Dwight Schrute probably got some royalties off his picture there. If y'all know who Dwight is, I bet we all do. If you have any questions anytime, please contact me. If you know anybody wanting to start a business, I'm a good referral for that person. I'll be glad to help them understand, what we just discussed, help them decide what they need, what fits their budget, what they buy now, how much do they buy later, is often what that conversation looks like for a new business. So. But anyway, thank you all very much. Mary, thank you again for having me. I appreciate it.